Have you ever sold a holiday home in the sun and thought about that lovely profit hitting your bank account? It's a fantastic feeling for sure. But what if I told you that profit might lead to a surprise tax bill right here in the UK? Well, that's exactly what we're going to tackle today. This guide, developed by the experts at My Tax Accountant, will help you navigate the complexities of your overseas gains. So, let's start with a really common scenario. Imagine you've just sold your beautiful apartment abroad. The sale went through, the money's there, but here's the bit that catches so many people out. HMRC often wants a slice of that profit. We're going to walk through exactly how to handle it so you can avoid any nasty surprises. So here's our roadmap. First up, we'll get to grips with the UK tax reality. Then, we'll dive into a brand new set of rules called the FIG regime. After that, we'll explore some pathways to defer and reduce your bill, look at the high cost of getting it wrong, and finish up with your expert next steps. Okay, let's get straight into Section 1. The first thing you absolutely have to understand is that when it comes to UK tax, it's a worldwide issue. So what even is capital gains tax, or CGT? Well, it's pretty simple, really. It's a tax on the profit you make when you sell something that's gone up in value. But here's the kicker. For UK residents, this isn't just about assets in the UK. It applies to your worldwide assets. That means whether your property was in Portugal or Preston, if you're a UK resident, HMRC is interested in the game. Let's make this real with a quick story. Meet Anya. She's a freelance marketing consultant based in London. A while back, she inherited an apartment in Lisbon and just recently sold it, making a very nice £50,000 profit. She sorted all the local taxes in Portugal and thought that was that. But she's now realized she might have a UK tax bill to deal with. Sound familiar? It's a situation lots of people find themselves in. Now, you do get a small tax-free allowance each year, but, and it's a big but, for the 2025/26 tax year, it's only £3,000. When you're talking about a £50,000 profit like Anya's, that $3,000 allowance is, well, it's not a lot, is it? Most property sales are going to blast right past that limit. So, what happens to the profit above that allowance? Well, it gets taxed, and the rate depends on your UK income. If you're a basic rate taxpayer, it's 18%. But if you're a higher rate taxpayer, that jumps up to 24%. Let's go back to Anya. If she's a higher rate taxpayer, she's looking at paying 24% on £47,000 of her gain. That's a potential tax bill of over £11,000. A huge amount to find if you haven't planned for it. Now let's look at the next step, and stay with me because this is a really big deal. We're talking about a game changer for anyone new to the UK. It's the biggest shakeup in this area for a generation. You see, the old way of doing things, the super complex non-dom status, is being thrown out, gone. In its place from April 2025, we have the new Foreign Income and Gains Regime, or FIG for short. It's designed to be much simpler. Basically, it's a 4-year tax exemption on foreign gains for people who are new to living in the UK. So, who gets to use this new FIG regime? Well, the rules are pretty strict. You have to have been non-resident for the 10 years right before you move to the UK. If you meet that condition, you get this 4-year window where your foreign gains aren't taxed here. But after those 4 years are up, you're taxed on your worldwide gains just like everyone else. You can see how timing becomes absolutely crucial here, right? Okay, so knowing the rules is one thing, but what can you actually do about it? Let's look at some of the strategic options you have for deferring or reducing that tax bill. And here's a pro tip that answers the #1 question people ask. Am I going to be taxed twice? The good news is no. There's a system in place specifically to prevent that from happening. It's called Foreign Tax Credit Relief, and here's how it works in 3 simple steps. First, you figure out the UK capital gains tax due. Second, you see how much foreign tax you've already paid on that same gain. Let's say Anya paid £8,000 in tax in Portugal. And third, you claim a credit for the lower of those 2 amounts on your UK tax return. So you effectively end up paying the higher of the 2 countries' tax rates, but you never pay tax twice. Now, what's really interesting is that in certain situations, you can actually delay paying the tax altogether. This is called rollover relief. It's mainly for business assets, but there are some very specific cases where it can apply to property too. And here's a fact that might surprise you. Let's say you're forced to sell a property, maybe through a compulsory purchase order. You might think you have to pay the tax bill straight away, but actually, you might be able to defer it using a special kind of rollover relief, as long as you reinvest the money. It's a real lifeline in a tricky situation. This leads us to another massive question we get all the time.
especially from people thinking about leaving the UK. Can you sell your main home here, buy a new one somewhere else in the world, and still get tax relief? And the answer is yes. A recent ruling confirmed it. As long as you are a UK tax resident in the year you sold your home, you can reinvest in a new main residence anywhere on the planet and still claim the relevant exemption. That is an absolutely crucial bit of planning for anyone selling up to move abroad. So, we've looked at the rules and some ways to manage the tax. But that's not all. Here's where most people go wrong. Let's talk about what happens if you make a mistake, because the penalties can be really high. Honestly, ignoring your obligations is a costly mistake. HMRC's penalties for offshore noncompliance are severe. They depend on your behavior, whether it was just careless or deliberate and where the asset was held. But just look at that bottom right corner. If you deliberately conceal a gain, the penalty can be up to 200% of the tax you owe. That's double the tax, on top of the original tax bill. It's just not worth the risk. So, having seen the risks, let's talk about the final and I think most important step, turning all this knowledge into the right action. So, let's just quickly summarize the key takeaways. First, UK residents are taxed on worldwide gains. Second, the annual exemption is tiny, just £3,000. Third, the new FIG regime is a massive change if you're new to the UK. Fourth, there are reliefs available, but they can be complex. And finally, the penalties for getting it wrong are significant. And this all really leads to one crucial question you should be asking yourself. With all these rules changing, are you absolutely confident that you're paying the right amount of tax and not a penny more? Trying to navigate this alone can be really tough. For tailored advice on your specific situation, whether it's about an overseas property sale or any other tax issue, the experts at My Tax Accountant are there to help. You can give them a call on 0208-570-8531 or drop them an email at info@mytaxaccountant.co.uk. And please just remember that the information in this presentation is for general guidance only. It really shouldn't be relied upon to make financial decisions. Before you take any action at all, you must consult with a professional tax expert like the team at My Tax Accountant.